when we talk about brand and what we deliver, if we're going to add something to our brand, then we want it to enhance our brand. We don't want to add things to our brand that dilute our brand, and that's very important. If you look at our credit product, if you look at our investment area, the investment areas that we want to grow, take our credit products, our long-short equity, or our real estate. When we go to look to try and win a mandate in that area, we have to be amongst the best in the world in that area. We're not going to win the mandate because of the firm's reputation, because of what we did in a different area, because of how we spoke at a conference. We're going to win that. If we're going to win that, it's because we're amongst the best in the world in that area. That's what we've always done. That's what we're always going to do. And that is our focus. And we think that these 4 areas give us a lot of room to grow. We are very confident that it enhances our ability to truly be a solutions provider. Let's all acknowledge solutions provider, which we started talking about 5 or 6 years ago, is becoming a little bit of an overused term. We really mean it. We can go to clients now and not say, hey, we have a product, we have a fund, here's why we think it's a good thing for you to do, would you like to invest? We could sit down with the CIO, with the fixed income, with the hard asset, with the opportunistic, with the multi-strategy. Tell us what you're trying to accomplish. Tell us what's worked for you, what hasn't worked for you. Tell us what would be interesting and attractive to you. Tell us how you'd like it to work, and let us show you that we've got amongst the strongest capabilities in each of those areas. Let us show you that in each of those areas, you're going to see a lot of commonality to the Octave brand. Intense investment focus, risk management, a lot of resources and capability, operations, financial controls, legal capabilities, firm relationships, etc. And that's the brand, and we're really focused on enhancing the brand. The 40 Act product is not our current focus. It is not our primary focus right now. Having said that, and I mentioned this earlier, if we'd had this conversation 5 years ago, private banks weren't our primary focus. We wanted to wait for the private banking channels to develop in a way that were most likely to be a positive experience for the client. You know, throughout our 20-year history, many times we're faced with new money coming into the space, but often it's commingled in ways and structures that we don't think are likely to result in a positive experience for the client. We're going to be patient. We recognize how large that market is. If you asked us, do we expect to be a player, not necessarily in the 40 Act market, but in the underlying assets that it represents at some point, absolutely. But our goal for now is to grow where we're looking to grow. In addition to private banks, don't forget there's a whole host of registered investment advisors that have never really been approached. The way we looked at the 3-year capital was we thought that was nothing but a plus for the firm, to the extent that, first of all, to have different tranches of capital that stagger the liquidity we thought made sense. You also have to remember, in 2008, we didn't gate or lock up $1 of any investor's capital, but a lot of managers did. And that meant that we suffered from what other managers did. I mean, we don't forget that. Our withdrawals, especially during 2009, which were residual 2008 withdrawals, were substantially larger than they would have been if other managers hadn't gated or locked up. Now, we think long term, first of all, we just feel it was the right thing to do. Second of all, we're proud that we positioned ourselves properly, didn't have to do it. And third, we think it's benefited us dramatically going forward. But the 3-year tranche is just another alternative. You know, once investors decide, here's the key. We recognized that the way that institutions are going to make their decisions, they're smart. There was a lot of talk after the crisis that the way investors were going to make their decisions were based on who would lower their fee. And investors didn't go for that. What they said was, we're going to decide who we want to be with. Once we decide who we want to be with, then maybe we'll have a discussion about structure. And we're comfortable with that. Well, 5 years ago, we were there. 5 years ago, I think if you said that one of my thoughts on the firm is that too much of the assets are in these multi-strategy hedge funds, and too much of the firm and its decisions are very concentrated at the top, On the first, we would have said, well, it's arithmetic. The numbers are the numbers. On the second, I think we would have said, actually, it's a lot more. The decision-making and potential for succession is a lot more well thought out than it looks from the outside, but we get why when one person's name's on the firm, things, and they founded the firm, things tend to look that way. But if you, on the product side, look at how we're looking to grow. Look at how we have grown, look at how we're looking to grow. If we execute on this plan of growing all 4 of our products, then we'll have a larger, more diversified firm. In terms of the on the people side, feel very, very good about what we've done there. We have a 7-person management committee that runs the firm and makes all the major decisions. That's been up and running for over 5 years, and that's working very well. I'm obviously one of the members of that committee. If you look at each of our different investment areas, who's running the different businesses? We have 2 partners who run equities globally. We used to have 1 partner who ran the U.S., 1 partner who ran Europe, 1 partner who ran Asia. Now, in addition to that, 2 partners who run equities globally. We have a partner who runs corporate credit in the U.S. and structured credit in the U.S., and then a partner who runs global credit. We have a partner who runs corporate credit in Europe and a partner who runs structured credit in Europe. We have a partner who runs equities in Europe. So ultimately the risk management and asset allocation decisions in each portfolio do get centralized to those committees and to the OCSIT process. But on a daily basis, those portfolios are run by the partners and portfolio managers in each unit. Sure. Well, since we've been answering that question since we went over $1 billion, it's an easy one to deal with. First of all, the multi-strategy funds, our plans have been and continue to be slow and steady growth. And if you look at our multi-strategy fund, both how we did in the financial crisis and since then, what clients see is that we've generated better returns with less risk and lower volatility and more nimbleness than most of our competitors. We've shown more of an ability to grow new businesses that make sense. This whole concept of banks not doing things differently, I know everyone's starting to focus on that. But that's going to be a market. We are very confident it's going to be a market where larger players are going to dominate. And that's part of the reason why our plan to grow the firm is to grow, in addition to growing the multi-strategy, to grow the credit products, to grow the long-short equity products, and to grow the real estate products. We're not having a problem on that front at all. But I think part of the reason is that what we've done for 20 years is absolute return. Very strong returns, very low risk. I think when you read the overall hedge fund numbers, I don't know the exact number they say is a hedge fund these days, but if they use a number of $2 trillion, everyone can make their own decision about how much of that $2 trillion is going to perform and how much is not. But remember what I said at the beginning. Institutions and other LPs are increasing their allocations to alternative managers where they believe that that alternative manager works for them. Investors are very, very comfortable with our returns this year as well as through cycles. I think it's part of the reason why we're offering different products. It's part of the reason why we'll offer a long-short equity product that by definition comes with more market exposure, but not changing what we do, just packaging it differently.